Welcome to our financial reporting session. We will be considering IS-23 borrowing costs. Well, before we begin, I want to mention that I'm going to keep it simple and straightforward. We're not going to discuss every single note, but our focus will be just on the main points and then we move on. So yesterday, because on Friday we mentioned that we are going to do borrowing costs on Monday, so somebody asked me a question that is there a difference between the borrowing cost in F7, that is 2.1, or the borrowing cost in advanced financial reporting, that is 3.1, and SPR for SCCA. So I told them that no, actually I want to make mention that there's no much difference. The standard is the same, and actually if you compare the SPR manual and the F7 manual, even the other 2.1 manual, you're going to find that actually the same example has been used in advanced financial reporting and also in F7. So the standard remains the same, except that this time around when explaining, the examiner expects you to talk like a manager, because at this time you are the one in charge. You are the man or the woman calling shots. So as you present your answers, be very professional. Let the main points come out. So this time around, the focus is not so much on calculation, but the focus is on how well do you understand the standard. They'll give you a scenario, so know what to say, when to say what, when to do what, when not to do what, and what to do, what not to do, the do's and the don'ts. Know the rules in short. So let's begin by discussing what the standard is about. Remember, I gave you a formula in the previous video. We talked about understanding financial accounting standards, and I told you that I have a formula which I've been using, the ARM, which is the ARM, and I explained that the A is the about, the R is the recognition, and then the M, that is the measurement. You cannot be reading a standard without understanding what the standard is about. So before you go anywhere, know what the standard is about. In this case, we are dealing with IAS-23. What is IAS-23 about? Number two, know the recognition criteria. It's only normal for you to know. When do we recognize what? The thing that an item must meet for it to be recognized in our financial statements. Number three, know the measurement, the accounting treatment. You know, sometimes it could be things such as initial measurement, what is the initial amount of money going to put in statements, subsequent measurement, things like that. So I want to use this formula on this standard IAS-23. So let's begin with the A, the about. What is IAS-23 about? So IAS-23 is a standard which deals with borrowing costs, and it tells us the treatment of borrowing costs incurred by an entity for the purpose of financing a qualifying asset. Or the statement borrowing cost simply means the interest incurred on borrowed funds by an entity for the purpose of financing a qualifying asset. But I want to mention that borrowing cost does not only limit to meaning interest. It could also mean costs associated with you borrowing that amount. Take for example, if you are selling a car, so in order for you to be able to sell that car, of course you call the newspaper, you put an advert in the newspaper, you buy bundles, you put it on social media, or you engage some agent to help you advertise and things like that. You are incurring all those costs because of one reason: you want to sell the car. If not for the purpose of selling the car, there is no way on earth you would have incurred advertising costs. So those costs that are directly attributable to the borrowed funds, they also form part of the borrowing costs, and they must be capitalized. When we say must be capitalized, we mean they must be added to the cost of the asset. Boom. I think that's easy, and that's important for you to know. Now remember the definition of borrowing costs. Again, we want to go back. We said borrowing costs These are costs incurred by an entity on funds borrowed for the purpose of financing a qualifying asset. Did you hear that? Qualifying asset. So this means that borrowing costs are not incurred on just an asset. It must be a qualifying asset. And that gives us a question. What's the question then? Can you tell me the question? What is a qualifying asset? Yes, a qualifying asset is an asset that takes a substantial amount of time to complete or to be made ready for its intended use, sale, or purpose. So in our local language, I can say, if sende state tadi muchakumuna kuti napere nganda ngamulekule nganda tete mukule nganda mubushukubo mwawe mukakule nganda ngani building ngani chinshi chikamsenda ma months nomba tatulanda pa ma months muri situation tulanda pa chintu chinga msendera more than 1 year okukula if you could wapa munga ama lodge ama guest house, things like that. So in simple terms, I'm saying that a qualifying asset is an asset that takes a substantial amount of time to complete and sell. So just because something takes you 10 months doesn't mean it's a qualifying asset. No, it's not. It must be a year and above. Okay? Alright. We are still talking about the A, the about. So now we're going what the standard is about. The main point. Now, we also want to give you other things this standard talks about. The other thing it talks about, it tells us when, now that we've identified the qualifying assets, so when should we start capitalizing? It tells us that. And this standard tells us that we start capitalizing, number 1, when borrowing costs are being incurred. Then number 2, when expenditure on the asset is being incurred. Number 3, when activities necessary for the preparation of the asset to make it a intended use or sale are taking place. Then it also tells us when to stop capitalizing. When the asset is complete, or part of it is complete, or there's a serious interruption, then we can stop capitalizing. And this standard also tells us something about disclosures. What should we disclose and when should we disclose? For example, it tells us that we must be able to disclose the amount of borrowing costs capitalized during the year. And this standard also tells us that let me just read from the note that we must also be able to disclose the capitalization rate used to determine the amount of borrowing costs to be capitalized. So basically, that's what this standard is about. It's important for you to know what the standard is about. And in the nutshell, I would like to keep it that way so we don't talk about a lot of things. Let's go to the second one. The R. Second one is the R, the recognition criteria. What is the criteria? What should these costs meet for us to be able to recognize them in our financial statements as costs that have been incurred on borrowings? Remember, we mentioned in the about already, there are only 3. Number 1, expenditure must be incurred on the asset. Number 2, borrowing costs must be incurred. Number 3, activities must be taking place for making ready the asset for intended use or sale. Now, when we say expenditure must be incurred, we mean you are actually paying cash here. If not cash, it could be a form of transferring of assets. So that's expenditure is being incurred. We don't just limit it to money, but it could be also a transfer of assets or interest-bearing liabilities, such kind of things. And then when you say activities are taking place to make the asset ready for intended use or sale, we don't just mean the physical construction of the asset. No, this could extend further to administration or any other activity that might be coincident or incidental to this construction. For example, you go and get permits and things like that. You are doing all these things because you want this project to work. Even for this project, there's no way you can go start getting those permits. That's what we mean. And then last but not the least, I want to talk. We're going to the last one, which is the measurement. Yes, the measurement is important. Well, IS 23 states that the effective interest rate must be used when capitalizing borrowing costs. And this is so especially when you're doing specific borrowings. But in a situation where you've got general borrowings, where a company, the examiner tells you that this company has been borrowing funds from Bank A, Bank B, Bank C. So in that context, what must you do? In that case, you must be able to come up with the weighted average interest rate to use for you to be able to capitalize. And how do you come up with that? You're going to get loan number one. Let's say you have 3 loans. You've got loan number 1, loan number 2, and loan number 3. Then each loan has got 10% interest, 20% interest, 30% interest. You get the first loan by 10%, you get the interest. Second loan by 20%, you get the interest. Third loan by 30%, you get the interest. Then you add those interests. You come up with the total interest. And then what do? Boom. You add the loans, the 3 loans, loan 1, loan 2, loan 3, you come up with the total loan amount. And then divide into the total interest to come up with the weighted average interest rate to use for your capitalization. So I want us to do a calculation. But before we do the calculation, I want to mention that this standard also tells us something very important. It tells us when we should stop capitalizing, and it tells us what type of assets we must not be able to make as part of capital. We must not be able to capitalize interest on. So let's say, for example, when you are constructing an asset, and I mentioned this area, if the asset has been completed, stop capitalizing. But the situations where this asset is being completed in parts or in stages, so the part that is completed, you must be able to stop capitalizing it. And then there's the situation where even if the asset has been completed, the part of the asset has been completed, it can't be sold until other parts are completed. So in that case, also this gives us proper guidance on how to do with it. We have to wait until the final piece is complete. So that is all about this standard, and we want to mention the type of assets you must not be able to charge this interest on. For example, an asset measured at its fair value, that kind of assets we must not be able to capitalize interest on them. Yeah. And I want to just ask you a brief. I want to look for a question. I'm scrolling down here. I'm trying to look for. I have a question. I just want to read for you, and then we'll discuss. Actually, it's a nice question. And I want to mention that on the assets that we should not be able to add interest on, I've mentioned assets made at their fair value, and also inventories that are manufactured or produced in a large quantities but on a repetitive basis. Such inventories must not be capitalized, their costs. So in the exam, be attentive, don't rush, take your time, see all the bits and pieces. And then also IS 23 tells us something very important to remember. It tells us that in a situation where you've borrowed funds and you've got an opportunity to invest surplus funds, the interest or the profit, in simple terms, on those surplus funds should not be treated to you as other income or profit. No, get that interest you've earned and go and reduce your borrowing costs. So let's say, for example, you go to the government or whatever it is, or the bank, you get this huge loan for the purpose of financing a qualifying asset, and then you get some money, but you leave some money in your bank account. So that money stays there for 6 months. It has earned interest worth of 6 months. So what do that interest for 6 months? You're not going to treat it as other income. No, you are going to get that interest and then look at your borrowing costs, and then reduce your borrowing costs by the amount of interest you've earned, so that your costs can go down. So then the best idea of this standard, just to help you see that when you borrow money, for example, go to the guy who you can pay 150. When you ask how much money did you borrow, don't say you borrowed 100 kwacha. No, say you borrowed a 150. Why? Because the 50 kwacha you're going to add it on top. So the total borrowed amount in short is 150, not 100 kwacha. That's the whole idea here. Okay, so let's consider a question, and I'm just going to pause a bit because today I don't have the equipment. As I mentioned, we bought some equipment to be using. Starting next week, our quality will be very good, because our equipments are on the way from China, but because of the coronavirus issue, there's been some held up here and there. But I just confirmed today in the morning that I'll be able to receive those equipments by Friday. So that means that you'll be able to now follow through. I'll be writing to the pages of the PDF and be able to go through and do the examples. But for today, I'll just pause the video and just show you the question. I've already worked it out, so you'll be able to follow through. I'm just pausing a bit and then continue. Okay, so like I said that I was going to pause the video. The idea was for me to show you this question. Now, this question is on general borrowings. Okay, maybe let's start with the question on specific borrowings. So I said there are two types of borrowing, as we mentioned earlier. We said we have specific borrowings, and then also we have general borrowings. So now look at this question here. It's a question to do with specific borrowings. And we said, according to the measurement rules, whenever we have the specific borrowing, we must be able to use the effective interest rate given by the examiner in the question. And that's what we're going to do in this question also. Look at that. What do the requirements say? The requirement says something like this here. That's the requirement there. It says, calculate the amount of interest MPOC must capitalize as at 31st December 2019. Yes, 2019. So I'm just getting my marker. I've already highlighted the main points, and I want to mention that we have some equipments which we just bought, as I mentioned, on Friday. Now, because of the coronavirus thing, we're having some held up here and there, but I just confirmed in the morning that we'll be able to receive by Friday. So come next week, our learning will be very much nice and interactive. So yes, the question says, Mapesa PLC started to build a new plant on 1st of February 2019. Now this construction was funded by a 15 million kwacha loan with an interest rate of 5%. Full stop. Now during July, construction was stopped. You see that point? During July, construction was stopped. You seen that? The interest rate was how much? 5% of what? Boom, 15 million. Okay. So calculate the amount of interest MPOC must capitalize at the 31st December 2019. So remember, step number one, you must determine. What are you determining? The number of months for capitalization. Okay, how do you do that? How do you determine the number of months for capitalization? Like I mentioned earlier, in this context, you must kind of assume a full year, less months without activity. So look at this question. This question, we are told they started constructing in February. So how do we assume? If we assume 12 months, and now that 12 months, we are going to less the month without activity, which gives us how many months? January, because January we had no activity. We said in February. But look at the other statement. July also had no activity because the construction was stopped. But we don't know why the construction was stopped. So in some questions they will tell you because of some strike. So if it was a strike, we are going to treat the interest for July as a loss in the statement of profit or loss. Okay. So step number one, we do that. Step number two. Now, as you can see, I've worked the example already. So in this case, we have 11 months less July, January is not counted for, which leaves us how many months? 10 months. So what do? You calculate the interest for capitalization. Simply get the 15 million and then multiply it by how much? By the effective interest rate of 5%. Now remember, how many months do we have? July is cancelled and January we have no activity. So that gives us how many months? Boom, 10 months. So when you multiply these, you are going to get 0.625 million kwacha. So that's how you do with specific loans. And let me just quickly take you to general borrowings. Okay, now general borrowings, we've got a story here. I've also worked out the example for general borrowings, and I'm hoping that you're going to follow through. So general borrowings also we go. Now remember, general borrowings is a situation where a company gets multiple loans from multiple sources. It could be 2, it could be 3, it could be more than 3. But in this context, we want to assume that the examiner just got 2, as we have been told in the question. So kindly look at the requirement, and what does the requirement say? The requirement says that calculate the interest to be capitalized on 31st of December 2019. Now let's look at the loans that we are dealing with here. So what are we dealing with? Look at that. We've been told Mapesa PLC started to build a new plant. When? On 1st of April 2019. Okay, the Mapesa PLC has 2 loans. The first loan is 10 million at 7%. I've highlighted that one. It's a bank loan. The second bank loan is 5 million at how much percent? 10%. Then we've been told Mapesa PLC used 3 million of the existing loans on 1st April 2019 and 4 million on 1st August 2019. Don't let the way the existing loans confuse you. They're talking about these same loans we're dealing with here. Okay. So now, how do you work out that? Now, this is the specific borrowing. Is this a general borrowing? So what do? You simply work out the weighted average interest rate. Now, how do you do that? The first thing you do, you come up with the total interest and then divide by the total loan amount. So what do? Look at the total interest. We have 10 million at 7%. Boom, we have got 0.7 million. 5 million loan at 10%, we've got 0.5 million. So what is the total interest? This plus this, we get this 1.2 million. Now look, I put a note there to be divided by total loan amount. What is the total loan amount? We are told in the question, total loan amount of how much? 15 million was taken to fund the business, to fund the construction. Where is that? Okay. Oh yeah, maybe. Okay, here it is. We've got 10 million here plus 5 million, which gives us a total of how much? Yeah, 15 million here. So it's not all that you're going to be told. Sometimes you're not told, just get the different loans, add them, come up with the total, as we did in this one. We have 15 million. So what do you do next? Next, you get the total loan amount divided into the total interest to get the weighted average interest rate. What is that? 0.08%. So this is the interest that you're going to use to capitalize your borrowing costs. So now you go to step number 2. Step number 2, you calculate the interest for capitalization. How do you do that? Simply get the 3 million. Go back to the question, see what you were told. You were told that 3 million of the existing loans were used on 1st April. Now assume a full year and remove months without activity. What is a full year? 12 months. Remove months without activity. That is January, February, and March are excluded. That leaves with how many months? Boom, 9 months. So get the 3 million, multiply by the weighted average interest rate, multiply by the 9 months over 12 to get the 0.18 million kwacha. And then do the same, because the question continually says and 4 million on 1st August 2019. So assume a full year and remove the months without activity. That is January to August to July. That is 6 months, 7 months. Yes, 7 months, which leaves you with 5 months only. So what do? You get the 4 million multiplied by the weighted average interest rate, then multiplied by 5 months over 12, which gives a 0.13 million kwacha. So what do? Boom, you add the 2, this plus this, you get the total amount to be capitalized. This is the amount of interest you're going to capitalize to make part of the cost of an asset, 0.31 million kwacha. I've put a note here which says remember months without activity. Yes, we've done that. We've removed the 3 and the 8, the 7 to remain with these 2 months, and then we have this one. So basically, that's what is supposed to be done when you're dealing with a question that has multiple sources of borrowing. It is not very much difficult, just for these simple instructions, and you should be good to go. So all you have to do is please be careful when you're dealing with a standard like this one. because sometimes you may be told that there was a strike. Now, when there's a strike, it's different. Remember, when there's a strike, the month for the strike is a loss. Remember that. So to summarize what we've discussed, we've talked about IS-23, a standard that deals with the amount of interest which we usually expense to the income statement, but in this context we want to add it to the cost, to the total cost of borrowing, so that we come to the cost of borrowing. So it's also standard which tells us the treatment of capitalization, capitalizing funds. How, when should we capitalize, when should we stop capitalizing, what should we disclose, when should we disclose. So I'm really hoping that this short video is going to be of great help to you. If you need more information or you need to come and do more with us, feel free to like our page or to send us a message, and we'll be happy to respond from there. So for now, let me just pause the video again, and then we can conclude with a simple comment. Thank you so much for watching. Let me just pause the video and then we finalize. Yes, so basically that was the example on borrowing costs. So now I want to mention that you must be able to take care of the exam, because some assets they are completed in parts, where the other part is being completed and being used, or others are still in progress. So what do? Capitalization for that complete asset must be able to stop. So basically, IS-23 is a standard that deals with borrowing costs. And what are borrowing costs? We've mentioned borrowing costs. These are interests that are charged by on funds borrowed by an entity for the purpose of financing a qualifying asset. And we've said borrowing costs does not just mean interest; it could mean direct attributable costs, such as cost of getting permits, admin, and these other costs that can be associated to the construction of this particular asset. And we've also talked about assets which must not be charged, whose cost must not be capitalized, like assets those whose values are measured at fair value. We've talked about those assets, and also want to mention that please, as we'll be dealing with this standard or any other standard, remember the what the standard is about, the recognition criteria, and the measurement. What is borrowing cost about? It's about the treatment of interest on borrowings that an entity gets for the purpose of financing a qualifying asset. Now this, when we say a borrowing cost, we are meaning either 2 or 3 things, whatever it may be. It could be interest, it could be other associated costs that are incidental to the construction of this asset. Then we also talked about what this standard tells us about cessation. When do you stop capitalizing? When the physical completion of asset has been achieved, or when part of the asset is complete, or when there's a serious interruption, like we saw in the question where there was an interruption in July, such kind of things. Disclosures, so it tells us that no, you must be able to disclose the amount of borrowing that you are able to capitalize during the year, and the effective interest rate that you use for your capitalized borrowings. They also told us when to start capitalizing. We were told whenever expenditure is being incurred, whenever there is a borrowing cost being incurred, and whenever activities are being carried out for that particular asset to be made, for it to be made ready for immediate use or sell. And then we've also discussed the recognition criteria. I've just mentioned the criteria, those 3 things that must be met: expenditure being incurred, borrowing costs being incurred, boom, activities taking place for making this particular asset ready for intended use or sale. Then we talked about the measurement, the use of effective interest rate, and also weighted average interest rate in case of general borrowings. So it's quite a rich standard, not too much. It's a bit straightforward, but can cause a lot of problems in the exam if you don't know how to go about it. So what I want to implore you is that please see the link between IS-16, IS-37, and IS-36. These standards are connected. See how these standards work together, because in advanced financial reporting, the examiner will not ask you simply to explain IS-16 period. No, they will give you a situation which requires the application of either IS-16, 36, 37 in one question. So you must be able to know how this situation can be handled under IS-16, under provisions IS 37 and under impairment IS 36. So you must be able to see how these standards are related. But for more information on standards and other financial reporting standards, including the whole syllabus, please feel free to send us a message on our page, and there's a number on our page. You can simply give us a call and we'll take it up from there. So usually, as we said, this for full lectures, and for those of you who want to enroll with us, kindly feel free. We've got a different platform where we do one-on-one sessions, where we're able to mentor you one-on-one. We tell you the do's and don'ts, and we help you according to your pace, because sometimes teaching people as a group poses a challenge, because some people learn faster than others. So if you feel that you don't have either enough time, or if you feel that you need more time to be taught alone, please feel free to give us a call, and we'll be happy to take it up from there. So from me, Shadrick, I want to say thank you so much for watching, and please remember to invite your friends to like our page, and also share the video with your friends. So till we meet next time, and we'll go to yet another interesting standard, financial instruments, or we can go to employee benefits, or we can go to impairment, or these other standards, but we'll choose one of those standards we're going to do it next time. Thank you so much for watching, and have a lovely day. Bye bye.